If you're studying for the California real estate exam, you're in the right place. I passed on my first try using these exact tools. So subscribe so you don't miss the next video. Let's get into it. Show me the money. It's time to dive into financing. You can expect 9% of the licensing exam to be related to financing. General concepts. Most homebuyers will use a loan to purchase property. This requires a process of making an application to a lender, getting the borrower and property approved, and agreeing to a specific loan product and term. Common loan programs for residential mortgages are conventional, Federal Housing Administration, and U.S. Department of Veteran Affairs. Each has different borrower requirements and a different risk profile for the lender. The lender uses the property as security for the loan. The borrower pledges the property as collateral in the case of default. This is called hypothecation, the pledge, and gives the lender the right to foreclose. By financing a real estate purchase, borrowers take advantage of leverage, allowing them to control a large investment with a minimal down payment. Down payment / amount to be financed. Amount of down payment plus the earnest money deposit plus the loan amount being assumed or obtained equals sales price. The down payment is calculated as a percentage of the sales price based on the lender required loan to value ratio, or LTV. Sales price minus down payment minus earnest money deposit equals amount to be financed. Underwriting. Loan underwriters analyze the borrower's credit, capacity, and collateral. They review loan documentation to determine the borrower's ability to repay the loan, capacity, ensure that the property value is adequate to support the loan, collateral, and verify the borrower's financial ratios, credit. Lenders and underwriters want to see solid property values as supported by the appraisal, strong buyer credit scores, and a steady credit and employment history. Debt ratios. Underwriters will calculate two ratios, the housing ratio and debt ratio. The housing ratio, aka the front end ratio. This is the borrower's projected monthly housing expense, principal, interest, taxes, insurance, second liens, and association fees divided by income. The required ratio will vary depending on the loan type and lender. For conventional loans, typically 25 to 28%. For FHA loans, typically 31 to 40%. And for VA loans, lenders ignore the front-end ratio, so no worries. The debt ratio, also known as debt to income ratio or the back-end ratio, is the total of all the buyer's debt obligations divided by income. The required ratio will vary depending on the type of loan and lender. For a conventional loan, it'll typically be between 33 and 36%. For an FHA loan, typically 43 to 50%. For a VA loan, typically cannot exceed 41%. After loan package analysis, the underwriter will recommend application approval or denial, and it may request more documentation. Credit scoring. Underwriters will review borrower credit scores to ensure they fall within the ranges outlined for a given loan product. Credit scores range between 300 and 850. A higher score represents a more creditworthy consumer, and lower score represents more risk for the lender. Lender requirements vary and depend on whether the borrower is seeking a conventional FHA or VA loan. Individual lenders may require higher credit scores than the stated minimum scores, as long as they don't do so based on any discriminatory factor. Credit scores impact interest rates and other loan terms. Conventional loans typically require scores of 620 and above. FHA borrowers must have a minimum credit score of 580 to qualify for a 3.5% down payment. Borrowers with credit scores between 500 and 579 may have to put down as much as 10%. Borrowers with higher credit scores and other compensating factors, such as cash reserves or additional income sources, may qualify for higher front-end and back-end loan ratios. Credit history. Underwriters also look at credit history, including several factors, such as the length of time borrowers have maintained credit, the length of time borrowers have maintained good credit, late payment history, available credit used, types of credit extended, banks, credit card companies, and mortgage loans. Points. One loan point is equal to 1% of the borrower's loan amount. Lenders charge loan points, aka loan origination fees, as compensation for processing a new mortgage loan. Origination fees are typically between 1 and 3% and typically cannot be more than 3% of the loan value. These fees might be negotiable between the lender and borrower. Borrowers may choose to pay discount points at closing to permanently reduce a loan's interest rate. Amount paid for points equals loan amount times number of points followed by a percent sign. For example, 1 point equals 1% of the loan amount. So if a lender charges 2 points on a $250,000 loan, the cost to purchase the discount would be $250,000 times 0.02, which would equal $5,000. Buy down. Interest prepayment at closing to temporarily reduce the interest rate, usually for a period of 1 to 3 years. A 3-2-1 buy down. A 3% interest rate reduction in year 1, 2% in year 2, and 1% in year 3. The interest rate returns in full year 4. Loan to value ratio. The LTV is the ratio of the loan amount to the property value, sales price, or appraised value, whichever is lower. For example, a $160,000 loan on a $200,000 home has an LTV of 80%. $160,000 divided by $200,000 equals 0.8 or 80%. LTV equals loan amount divided by value times 100. Lenders use LTV to determine required down payment amounts when initially writing mortgage loans or when homeowners apply for a home equity loan or a home equity line of credit. Interest. Interest is a fee paid back to a lender for the use of its money. The amount of interest paid with each mortgage payment typically decreases over the life of the mortgage. Interest rates are stated as an annual percentage. For example, 6% interest rate is 6% for the period of 1 year or 0.5% per month. Annual percentage rate, APR, is a measure of both the interest rate and other fees associated with mortgage loans. Lenders lock in interest rates for a period of no more than 90 days. If the closing process takes more than 90 days, borrowers may face an interest rate change. PITI. The most common mortgage loan payment includes a portion of the principal balance, current accrued interest, and a 1/12 portion of the expected annual property tax and homeowners insurance balances due. Principal, interest, taxes, and insurance, or PITI. This may also be referred to as a budget mortgage because it's easy to budget around known monthly payments. Lenders place the property tax and insurance amounts collected each month in an escrow account and pay the annual tax and insurance bills when they come due. The loan payments can be determined by an amortization chart. To use an amortization chart to calculate a monthly principal and interest payment, find the interest rate and the term of the loan on the chart. The factor is how much would have to be paid monthly to borrow $1,000 at that rate for that many years. So for example, a 2% rate for a 15-year loan term equals a factor of 6.43509. So monthly payment equals loan amount divided by 1,000 times the factor. On your exam, we might be expected to perform a number of interest and payment calculations. So here are some to keep in mind. Loan balance times interest rate equals annual interest. Just remember that one. Divide annual interest by 12 to get monthly interest. Monthly payment times total number payments minus original loan value equals total loan interest amount. To find the amount of each monthly payment that's credited toward principal, calculate the monthly interest amount on the current principal balance. Subtract that amount from the monthly payment. The remainder goes toward principal. The loan amount is $315,000 with a 5% interest rate and a 30-year term. The monthly principal and interest payment is $1,890. To calculate the amount owed after the first payment is made, take the loan balance times the interest rate, which equals the annual interest amount. $315,000 times 5% equals $15,750. This amount divided by 12 months in the year equals $1,312.50 of monthly interest. Monthly principal and interest minus first month's interest equals amount applied to principal. So $1,890 minus $1,312.50 equals $577.50. Loan amount minus amount applied to principal equals the remaining loan balance. 315 minus 577.5 equals $314,400. $422.50. Types of loans. Conventional loans are the most common type of residential mortgage. The borrower usually pays at least 20% of the purchase price as down payment, so the lender doesn't rely on a government entity, such as FHA or VA, to reduce the risk of loss. Many conventional loans are also conforming loans, meaning they meet the requirements of Fannie Mae or Freddie Mac and can be sold to one of these entities. A conventional mortgage that exceeds the dollar limit Fannie Mae and Freddie Mac set is called a non-conforming loan or a jumbo mortgage. This type of mortgage can be sold on the secondary market but isn't purchased by Fannie Mae or Freddie Mac. Lenders may require private mortgage insurance, PMI, on conventional loans when the down payment is less than 20% and the loan-to-value ratio is in excess of 80%. Loans with an LTV in excess of 80% don't conform to Fannie Mae, Freddie Mac guidelines, so lenders may require PMI to offset the risk. PMI protects the lender in case of borrower default. Lenders must terminate PMI when the principal balance is scheduled to reach 78% of the original property value or when the mortgage loan reaches its originally scheduled amortization midpoint. Borrowers may request PMI termination when the principal balance drops below 80% of the loan balance. Depending on market conditions and property updates, this may permit borrowers to remove PMI earlier in the mortgage loan term. Quick pause. If you're studying with me, subscribe so you don't lose this. Okay, back to it. Government loans. Provided by a lender, but insured by the FHA or guaranteed by the VA. Some government loans are offered by another government entity, such as the USDA or the U.S. Department of Agriculture. Subprime loans. Legitimate loans offered to borrowers with credit ratings that don't meet the requirements for a conventional loan. These loans are offered with higher interest rates, up to 5% over the current market rate, to account for the lender's level of higher risk. Loan terms may vary according to lender programs and borrower needs. Loans usually fall within one of these categories. Amortized loan. Amortization is the process of paying an amount in installments over time. With an amortized loan, the monthly payment amount is the same each month. Each monthly payment is credited first toward monthly interest on the loan, with the remainder used to pay off a portion of the principal. Over time, the principal portion of the payment increases each month, while the portion going toward interest decreases. Fixed rate mortgage. The principal and interest rate remain the same for the life of the loan. Term or straight term. Borrowers only pay interest for a set term and then pay off the loan in a lump sum or through another loan. Adjustable rate mortgages, ARMs. The interest rate fluctuates based on the economic index. ARMs typically have a lower interest rate for an initial period of 1 to several years. ARM rates adjust based on an economic index rate the lender selects, such as London Interbank Offered Rate, LIBOR, LIBOR, or the Treasury Bills Index. An index rate is simply a benchmark that a given lender selects as the basis for the adjustable rate. An ARM's interest rate is typically equal to the current index plus a specified margin. For example, the current Treasury Bill Index rate plus a margin of 2%. Cap rate is a limit on how much the interest rate can increase. The initial cap rate limits the amount that interest can adjust at the first adjustment. The periodic cap limits the amount the interest can adjust at each adjustment period. The lifetime cap limits the total amount of adjustment that can be made over the life of the loan, usually expressed as a percentage increase from the initial interest rate. A bridge or swing loan. This temporary, usually 90-day loan provides funds until permanent financing can be obtained. Home equity loan. This loan is based on the equity in a home. It can be a first mortgage if the home is fully owned, or a second mortgage. Home equity line of credit, HELOC. This is a line of credit based on available equity, which homeowners use as an open-ended account. A reverse annuity mortgage, or RAM. This is a loan in which property owners receive payments from the bank based on the equity in their home. Over time, the bank gains ownership of the property. Package mortgage. Commonly used in commercial real estate where business assets are included as collateral. This mortgage includes personal property with the real property in the sale. Construction loan. This is used as temporary financing for construction. The loan is based on lender review of plans for improvement and an appraisal. Loan assumption and subject 2. In situations where interest rates are on the rise, buyers may want to take over or assume a seller's existing loan. Loan terms and the lender must permit assumption. However, certain transfers are protected under federal law, such as the transfer between a parent and child. In an assumption, the buyer assumes personal liability for the existing loan. When the property is sold subject to the existing loan, the agreement is between the seller and the buyer. The original borrower remains responsible for the debt, and the buyer makes payments to the seller. Sources of financing. Lenders are in business to make loans. They make loans on the primary market to consumers and sell packages of loans on the secondary market, freeing up funds to make, you guessed it, more loans. Primary mortgage market is made up of lenders that originate and fund loans directly to consumers. The secondary mortgage market consists of entities that purchase mortgages from originating lenders and package them into investment products for investors. This frees up primary mortgage funds so lenders can make more loans. Without the secondary mortgage market, lenders would struggle to make funds available for borrowers. Key secondary players are Fannie Mae, Ginnie Mae, Freddie Mac, and Farmer Mac. Fannie Mae and Freddie Mac are government-sponsored enterprises, or GSEs, and as corporations are traded on major stock market exchanges as FNMA and FMCC. Fannie Mae and Freddie Mac purchase loans that conform to their lending standards, then package them as mortgage-backed securities, MBSs, and sell them to investors. Loans to be sold to the secondary mortgage market must conform to Fannie Mae and Freddie Mac standards related to borrower credit scores, down payments, and loan limits. Loans that either FNMA or FMCC will acquire may not exceed the existing conforming loan limit for the geographical area in which the property is located. Farmer Mac. Farmer Mac buys agricultural loans from rural lenders and issues MBSs for sale on the secondary market. Ginnie Mae guarantees MBSs that contain only government-insured or guaranteed loans, so FHA or VA. Because these are considered riskier loans, investors are encouraged to purchase them from the secondary market because they're backed by Ginnie Mae's guarantees. Seller financing. Sellers may agree to finance buyers with a purchase money mortgage. The buyer retains title to the property, but the seller takes a security interest for some or all of the purchase price. The buyer retains title to the property, but the seller takes a security interest for some or all of the purchase price. The buyer makes payments to the seller. Buyers may be able to combine a purchase money mortgage with a bank mortgage and the down payment. A wraparound mortgage. This involves the seller's existing mortgage and a buyer's new mortgage. The new mortgage wraps around the existing mortgage, and the seller continues to make payments on the existing mortgage. The buyer makes payments to the seller that covers payments for both the existing and new mortgage loans. Sellers may also agree to take a second mortgage for a portion of the property's purchase price, with the remainder financed through a traditional mortgage loan. A land contract. Contract for deed. Sellers, vendors, may agree to finance buyers under a land contract for deed, especially if the buyer, vendee, is unable to secure traditional mortgage financing for the purchase. With this financing method, the seller retains title to the property until the buyer repays the loan in full. The buyer has possession and equitable title during the repayment period. The holders of equitable title have the right to future full ownership of the property once they meet certain conditions. In this case, loan payoff. Recording the land contract in the land records offers protection for the buyer's interest in the property. Government programs. FHA-insured loans. The FHA insures lenders against loss in case of borrower default. The FHA was created in 1934 to stabilize the mortgage market by standardizing credit and construction standards. The FHA has been part of HUD since 1965. The FHA funds its loan program through mortgage insurance premiums that borrowers pay. The FHA helped the mortgage market by standardizing borrower qualifications, establishing the long-term amortized loan, improving construction standards, requiring appraiser certification, and opening up the global market for MBSs. FHA offers numerous loan programs to meet borrowers' varying needs. HUD and the FHA offer specific mortgage programs to support disaster relief and reverse mortgages, as well as home purchases for good neighbors, law enforcement, firefighters, and teachers, recipients of housing vouchers, and Native Americans. The Home Equity Conversion Mortgage, HECM, insured by the FHA, is the most popular form of reverse mortgage available for seniors. Special programs exist through the FHA for financing energy efficiency improvements in conjunction with an FHA-insured mortgage. Most consumers who use FHA financing will probably use 203B program. Lenders that want to make FHA loans must ensure that borrowers meet underwriting standards regarding down payment amounts, buyer scores, and loan limits, among other qualifications. Borrower qualification requirements for an FHA-insured loan are total housing expenses at or below 31% of gross monthly income and total debt obligation, including housing expense, of not more than 43%. Borrowers must have a credit score of at least 500 to obtain an FHA-insured loan, but a score of 620 or higher is preferable. FHA borrowers must pay a minimum down payment of 3.5%. Sellers or borrowers may buy down interest rates to make buyers' mortgage rates more affordable and make it easier for the borrowers to qualify for the loan. A mortgage insurance premium, MIP, applies to all FHA loans for the life of the loan. It's paid as an upfront charge at closing, then as an annual premium until the loan is paid off or refinanced. The annual MIP is calculated each year based on the amount of the loan-to-value ratio, and the loan duration. It's then divided by 12 and included in the borrower's monthly mortgage payment. The upfront MIP may be paid in cash at closing, or it may be financed into the loan, increasing the loan principal. FHA loans are available to anyone who qualifies, but may be more attractive to borrowers who have lower credit scores and down payments. FHA imposes a maximum loan amount, aka FHA lending limit, that it will guarantee for each borrower. These loan limits typically mimic conventional conforming loan limits. Buyers who wish to borrow more than these limits must make up the difference with their down payment. FHA loan limits vary by area and property type: single family, triplex, etc. VA guaranteed loans. The VA guarantees loans made to qualifying veterans. Benefits of a VA loan for borrowers include 100% financing, meaning no down payment required, competitive rates, no prepayment penalties, no mortgage insurance premiums, though there is a funding fee, and assistance for borrowers who have difficulty making their mortgage payments. The VA guarantees up to a quarter of the loan limit amount should the buyer default. This minimizes risk for lenders to make up for the no down payment VA loan structure. Because the VA guarantees 1/4 of the loan amount, basic entitlement means that veterans throughout most of the country can borrow up to $417,000 without putting money down. The VA loan program uses qualifying requirements aimed at ensuring the borrower's ability to pay off the debt without undue financial stress, which may be responsible for the low default rate. Credit score requirements are lower for VA loans than for conventional financing, and recent bankruptcies don't disqualify a VA borrower. Compensating factors can help borrowers of VA loans qualify, even if their qualifying ratio doesn't meet VA requirements. VA loan eligibility depends on the length and type of service, but in general is available to military members who have served 181 days of active duty or 3 months during wartime. Most VA lenders adhere to conventional conforming loan limits. This doesn't limit the amount that borrowers may borrow, but borrowers whose loans exceed these limits must make a down payment. Under a land contract for deed, property purchased with a VA loan must be used for owner occupancy, though loan funds can be used for home improvements or even building a home. The Veteran's Certificate of Eligibility, CO, determines eligibility and the amount of the entitlement. Applicants for a VA loan must use an approved lender. A VA assigned appraiser must provide a certificate of reasonable value, CRV, that qualifies the property and determines the amount of loan the VA will guarantee. If the CRV is less than the sales price, the borrower can bring cash to make up the difference, ask the seller to reduce the sales price, or some combination of the two. VA loans restrict the types of closing costs borrowers may be charged. Either sellers or buyers may pay the veteran borrower's closing costs, or they can share the costs. If the seller pays, it's not considered a seller concession. Seller concessions on a VA loan may not exceed 4% of the sales price. Most borrowers are required to pay a funding fee. The VA loan funding fee covers losses if the borrower defaults. The fee is a percentage of the loan amount and may be paid at closing or rolled into the loan, provided it doesn't exceed the loan limit. The percentage charged for the VA funding fee varies depending on military status, down payment amount, and whether the loan is a first-time or subsequent VA loan. Disabled veterans and spouses of veterans who have died in service or as a result of service-related disability are exempt from paying the VA funding fee. The VA loan entitlement can be used multiple times, and if the amount of entitlement is only partially used by one loan, the veteran is eligible to use the remaining entitlement on another VA loan. The VA provides housing adaptation grants to those with service-related disabilities, providing funds that allow veterans to buy or build adapted housing or to modify their current housing to meet their needs. VA special loan programs include cash-out refinancing, interest rate reduction, and direct loans for Native American veterans on federal trust lands. CalVet. The CalVet program is available to nearly all California veterans and offers low down payment and other favorable terms. CalVet offers easier terms than most loan programs, including VA loans. The CalVet funding program is available to most military personnel, including those who have been honorably discharged and are no longer actively serving. The property must be purchased for owner occupation and must be in California. All CalVet borrowers must purchase homeowners insurance through CalVet itself. CalVet borrowers under age 62 are required to buy life insurance. With a CalVet loan, CalVet holds legal title to the purchased property. The veteran holds equitable title to the property until the loan is paid off. CalVet borrowers may not lease or transfer ownership in their property without permission from the California Department of Veterans Affairs. California Housing Finance Agency. The CalHFA Mortgage Assistance Program provides financing assistance for qualified low and moderate income buyers. The CalHFA lending program is available to owner-occupied purchasers of California properties. Under this program, both the borrowers and the properties being purchased must qualify. Agricultural financing. The financial circumstances of rural and agricultural property buyers often don't meet conventional underwriting standards. The federal government offers several programs to meet their needs when purchasing real estate. The Farm Credit System, FCS, is a cooperative of individuals and business owners that provide funding within its group. The Federal Farm Credit Banks Funding Corporation raises money for FCS loans through the sale of securities in the U.S. and international markets. Farmer Mac makes agricultural loans possible by creating a secondary market for these loans. The USDA Rural Development Program offers loans, grants, and loan guarantees for housing and other rural needs. The USDA Farm Service Agency offers direct loans to farmers and ranchers, funded through congressional appropriation. These loans are provided only to fund land purchases and improvements for farms and ranches. USDA Farm Service Agency guaranteed loans provide agricultural lenders with a guarantee of up to 95% of the loss of principal and interest on a qualified loan. Applicants for USDA Farm Service Agency direct farm ownership loans must have participated in the day-to-day management of a farm or ranch for at least 3 years. The maximum loan amount for a USDA Farm Service Agency direct farm ownership loan is $300,000 with no minimum loan amount and no down payment required. Mortgages, deeds of trust, notes. Financing instruments include security instruments such as mortgages, deeds of trust, and promissory notes. The property is pledged as collateral. This type of pledge is called hypothecation. Some states use mortgages as security instruments. Two parties are involved: the lender, mortgagee, and the borrower, mortgagor. The mortgage typically places a lien on the property. California typically uses a deed of trust as the security instrument. The deed of trust involves the borrower, trustor, the lender, beneficiary, and a neutral third party, trustee. The trustee holds title in the borrower's name until the loan is paid in full. Both the mortgage and the deed of trust are accompanied by a promissory note, which is the borrower's promise to repay the loan. The lender holds this note until it's repaid. The date of the promissory note is used to determine lien priority. The lender, payee, holds the note until the loan is fully repaid. When the borrower pays off the loan, the lender marks the note as paid in full and returns it to the borrower. Promissory notes should detail the loan amount, interest rate, repayment terms, loan length, late fee provisions, prepayment penalties, what constitutes default, and the lender's default remedies. Promissory notes are negotiable instruments. meaning that the holder can transfer the right to receive payment to a third party. The third party can enforce the promissory note and other loan documents in the same way the original holder could. Generally, states that use mortgages as the security instruments are considered lien theory states because the mortgage creates a lien against the property until the loan is paid in full. The borrower holds legal title to the property even during the term of the loan. This typically requires that the lender uses a judicial foreclosure process if buyers fail to pay the mortgage loan. Generally, states that use deeds of trust are considered title theory states because the lender or a third party holds title to the property until the loan is paid in full. The trustee holds the legal title until the loan is repaid. The borrower has equitable title, which means having the right to obtain full title when the mortgage loan is paid in full. It also gives the borrower the right to possess, aka live, on the property. This typically means that the lender may use a non-judicial foreclosure process. A standard clause in the deed of trust is the power of sale, which gives the trustee the right to sell the property in case of default. California Civil Code, enacted in 1986, made the deed of trust and the mortgage instruments functionally equivalent in terms of creating a lien on the property being held as collateral. That makes it a lien theory state that uses the deed of trust as the typical security instrument. Under this law, the borrower holds both legal and equitable title during the term of the loan. The deed of trust gives lenders the right to use non-judicial foreclosure if the borrower defaults. Although lenders may choose to use a judicial foreclosure, California foreclosure laws allow the borrower a statutory right of redemption for up to 1 year if this method is used. Financing credit laws. The Truth in Lending Act, TILA, of 1968 requires lenders to disclose credit terms and conditions when advertising trigger loan terms so as not to mislead consumers. Trigger terms and ads that would require the full disclosure of all terms include down payment, payment amount, number of payments, and interest rate other than APR. Regulation Z requires mortgage lenders to follow TILA disclosure requirements for real estate advertisement that include credit terms. The Real Estate Settlement Procedures Act, RESPA, of 1974. This is a consumer protection statute designed to protect homebuyers from unscrupulous lending and settlement practices. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010, Dodd-Frank Act, handed RESPA responsibility to the Consumer Protection Finance Bureau, CFPB. Under RESPA, licensees are prohibited from paying or receiving a fee, kickback, or anything of value based on referring customers or clients to a settlement service provider. Third-party settlement providers may compensate licensees and brokerage firms only for actual services rendered to licensees and brokerage firms. Licensees and brokerage firms may distribute service provider marketing materials, pens, calendars, etc., with the service provider's name and contact information. Under certain circumstances, service providers may sponsor educational events for and offer continuing education credits to licensees as long as any costs a licensee would traditionally bear aren't defrayed by the event. This exemption refers to short-term events, a lunch and learn event, for example, but not necessarily to an all-expense paid trip to Tahiti in which a short period of time is devoted to training. Under provisions of the Dodd-Frank Act, the CFPB enforces regulations that prohibit lenders from funding higher-priced mortgage loans without regard for a borrower's ability to repay the loan. Lenders must take reasonable steps to ensure that consumers have the financial ability to repay a loan that uses a dwelling as collateral. Lenders comply with these provisions by writing what's referred to as qualified mortgage loans. A qualified mortgage is a loan category that has certain affordability features. Certain loan attributes are prohibited, including interest-only loans or interest-only periods on a loan, negative amortization, periodic principal payments that aren't sufficient to completely amortize the loan by the end of the loan term, balloon lump sum payments that are required at the end of the loan term to pay the loan off, loan terms of more than 30 years. Qualified mortgages also must adhere to standard lending ratios and can't exceed specified amounts for upfront loan points and fees. In addition to its prohibition on kickbacks and referral fees among service providers, RESPA requires that lenders provide written disclosures to help make estimated and final settlement costs clear and fair to consumers. This is accomplished through the TILA-RESPA Integrated Disclosures. Lenders must provide the loan estimate to applicants within 3 business days of loan application. The loan estimate document provides buyers with costs they are likely to pay at settlement and discloses the mortgage loan specifics, such as its key features, costs, and risks. Lenders must provide the closing disclosure at least 3 business days before closing. It provides final loan details, including the loan terms, projected monthly payments, fees, and other closing costs. TRID disclosures apply to financed home purchases, most loan assumptions, refinances, home improvement loans, and HELOCs on 1 to 4 unit residential properties. Commercial and business loans are exempt from RESPA. When the seller provides financing in California, the arranger of credit must ensure that the seller provides certain disclosures to the buyer, and the buyer provides certain disclosures to the seller. Predatory lending is unfair or abusive lending to buyers. Predatory lenders impose deceptive, coercive, and exploitative practices to take advantage of consumers to increase their debt while financing risky loans. A loan is considered predatory when it's more than 5% over the current market rate. An interest rate of up to 5% over the current market could be a legitimate loan for a high-risk situation, such as a subprime loan. Fraudulent lending practices take advantage of consumers, encourage debt, don't consider affordability, encourage refinancing multiple times, hide fees from borrowers, and often occur in the subprime loan market. The Equal Credit Opportunity Act, ECOA, of 1974 prohibits lenders from making credit unavailable or offering less favorable terms based on protected class status. Usury, lending money at an excessive, illegal rate. Usury laws are designed to protect consumers from exorbitant fees and interest rates by limiting what lenders charge to reasonable amounts. In California, a loan secured by real estate and arranged by a real estate broker is exempt from usury laws, which would otherwise limit the interest rate to 10% or less. Loan brokerage. The SAFE Act of 2008 specifies requirements for residential mortgage loan originators, MLOs, and requires MLOs to register with the Nationwide Mortgage Licensing System and Registry, NMLS. The California Residential Mortgage Lending Act requires licensing of companies that and individuals who make, service, and sell residential loans. It applies to mortgage bankers and brokers. Real estate licensees must have an MLO endorsement if accepting compensation for taking a residential mortgage loan application or offering or negotiating the terms of a residential loan application. Performing administrative or clerical tasks as an employee of an MLO doesn't require an MLO endorsement. For purposes of loan origination laws, a residential mortgage loan includes loans to purchase a residential property, to refinance an existing residential property loan, or to open a home equity line of credit, as long as they're secured by the real estate using a mortgage, deed of trust, or similar instrument. An MLO endorsement gives the licensee a unique identification number in the NMLS. The licensee must disclose this number and must include it in first point of contact sales materials, along with the real estate license number. Maintaining an MLO endorsement requires annual renewal, which involves completing continuing education requirements, submitting a request to the NMLS, and paying a renewal fee. Renewals must be completed by December 31st. The California Mortgage Loan Broker Law requires a specific disclosure statement and includes restrictions on how much mortgage loan brokers or mortgage loan originators may charge for their services. This law is also known as the Necessitous Borrower Act, the Real Property Loan Law, and Article 7 of the Real Estate Law. Types of loan originators. Commercial banks are large national and smaller state and local banks that make consumer and business loans. Savings and loan associations, aka thrifts, specialize in using savings deposits as the source of loans. Credit unions are member-based cooperatives that provide credit for auto and home loans. Mortgage brokers don't actually lend money. Instead, they work with multiple lenders to search for and negotiate the best deal for a specific borrower's circumstances. Real estate licensees with an MLO endorsement are working as mortgage brokers. Mortgage bankers actually do the lending. Because they often have in-house loan processors and underwriters, they can close on mortgage loans fairly quickly, but their lending options are usually limited to their own suite of products. And that wraps up financing. If you want more full study guides like this, subscribe and turn on notifications. Your next lesson is waiting. Go watch it now.